Most people think that tax planning is really all about Roth contributions, maybe Roth conversions, and managing those tax shelters. Yeah, that's part of it, but you also cannot let taxes leak through your non-retirement accounts. I've got 5 ways you can be more tax efficient with your non-retirement investments. I've got that and more coming up. If you're investing outside of your tax shelters, you have to make sure that you are doing so in a tax efficient way. Don't get me wrong, you need to have a very clear and well-defined tax shelter strategy that's consistent for your unique financial situation. Is that maxing out your pre-tax 401k, but then contributing to your Roth IRA? Is it contributing to your Roth IRA and maxing out your HSA? What makes the most sense for you? But in addition to that, if you're going to have dollars invested in non-retirement accounts, so not in your 401k, not in your Roth IRA, not in a traditional IRA, if it's just in an individual account, joint account, a trust account, you've got to be mindful of how you can ensure that those dollars are tax efficient as well. Why? Because I know what's going to happen. That you maybe receive some inheritance dollars and maybe some mutual funds that your parent was invested in, and you just don't know what to do. And if these were good enough for mom and dad, then they're good enough for me. So I'm just going to hold on to them. And over time, they've grown and grown. In every single year at the end of January, when you get your tax documents, you get a surprise of how much capital gains you have to report on your tax return. And it's going to cause and wreak a lot of havoc. It's going to cause you to pay more taxes. It's going to cause your Social Security to become taxable, maybe even cause you to pay an income-related monthly adjustment amount on your Medicare Part B and Part D. So that could happen. Another thing that could happen, the investments could perform so well that now you've got so much unrealized capital gains that you're sort of handcuffed. There's nothing you can do. You can't sell this investment because it's going to create so much tax pain. You just don't know what to do. You need to be mindful. You need to be planful and make sure that you are tax efficient with your non-retirement dollars. I've got 5 ways you can be even more tax efficient with those funds. The first is asset location. Make sure that you're putting the right assets into the right accounts. That's right. Not all investments are appropriate for every single account, for each of the different accounts. So the approach of having tax diversification and having your 401k and your Roth IRA and then also a non-retirement account, just an individual account, all invested the exact same way, that is not tax efficient. Likely, that is not tax efficient. What are a couple of examples? It likely, if it makes sense for your overall risk tolerance and asset allocation to hold some bonds, you're probably not going to want to hold bonds inside of a non-IRA. If you had the option to have the bond investments inside of a pre-tax account, that's typically where it makes the most sense because they pay interest. That interest is taxed as ordinary income. Likely you don't want that in a joint account if you can avoid it. Also, very active stock-based mutual funds, ones that the manager can buy and sell where you don't know what they're doing, you don't have any control or influence over it, and then all of a sudden you get a big tax surprise. Those are a couple of examples of investments that typically, if you can avoid it, you shouldn't have those in a non-tax sheltered account because they are not tax efficient. So the location of the investments that you hold, that matters. Second, inside of your non-retirement investment accounts, make sure that you're using low turnover, tax efficient investments. These are things like an index fund, okay? If you're using mutual funds, use an index fund, one that likely isn't going to have a lot of changes to it and have to pass out capital gain distributions. Better yet, in what we use exchange traded funds, ETFs. They have a special tax structure that allows many of them to avoid having any pass-through capital gains altogether. Many people think that exchange traded funds, well, it's not allowed. They're not able to have capital gain distributions. No, they are if they don't do their trading correctly. Most of them, they're very, very sensitive to this, and they do that in-kind transferring to avoid capital gain distributions. This capital gain distribution that I've talked about, this is where you're holding the same investment and you don't sell it. Let's say you bought it here. It's currently worth this. You didn't sell it. So there's no realized capital gain, But inside the fund, underneath the hood, you can't even see it. The manager bought something down here, they sold it up here, and they have to pass along those capital gains to the shareholders. Mutual funds, exchange-traded funds, they don't pay taxes themselves. The owners of those investments do, and that's those capital gain distributions. You don't have any control over them. You don't have any influence. They surprise you, and they can wreak a lot of havoc on your tax return. So using low turnover tax efficient funds inside of your non-retirement accounts makes a ton of sense. Third, make sure you have a system for harvesting capital losses. When the market feeds you lemons, do you have a system to make lemonade, or are you just emotional? Typically when the market's going down, many investors just get emotional. They clam up, they don't want to look, or they panic and end up doing something that is costly in the long term. Instead, be pragmatic, be unemotional, and taking a look at your non-retirement accounts to say, well, are there any investments here that I like? I like the category, but they're currently down in value. I have a capital loss that I could sell, capture a tax deduction, and then buy something similar or rebuy the same investment in 31 days and be able to capture that tax gain while still holding that investment for the long term. What's best is having a system for this, because there's a lot of ways that you can do this wrong. If you buy the same or a substantially similar investment 30 days before you sell or 30 days after you sell, that can wash the sale, which means you don't get the loss on your tax return. So having a system makes a ton of sense. Likewise, number 4, managing capital gains intentionally. This helps you avoid that risk that I mentioned earlier, where over the years you have an investment in a non-retirement account that grows so significantly over, a couple decades. It's doubled 3 or 4 times, where you say, well, I have to hold it. I can't sell this. You feel stuck. And if you've never been in this situation, you might say, well, that's crazy. I would never feel that way. No, many people do. And they can feel like they're painted into a corner. Well, I had this incredible investment and I've got lots of resources. I just can't use them because it's going to be so taxing. Managing the harvesting of those capital gains over time, typically in concert with another tax planning strategy like a donor advised fund or some other charitable giving, can make a ton of sense. So that's the 4th way to be more tax efficient with your non-retirement investments. And then number 5, I mentioned donor advised fund. That number 5 is to be strategic about donating appreciated investments instead of cash. That's right. When you hold investment dollars outside of your tax shelter, so in a non-retirement account, and you see appreciation on that, if you are charitable, either whether that's giving to a church or whether that's giving to a cause that you care about, doing a gift of those investments instead of cash can make a huge difference in being tax efficient. Why? Because when you make that donation, as long as it is a long-term cap gain, right, that you're dealing with, then you are getting a deduction on the market value of those investments. You get to claim that on your tax return if you're itemizing, whether you're donating that stock to your donor advised fund or directly to the charity. However, that donor advised fund or that charity, they're a nonprofit entity. So they don't want your investment. So they sell it, but they don't pay any capital gains. It's a capital gain avoidance strategy altogether. Makes a lot of sense when you're charitable and have non-retirement investment dollars. So does it make sense as part of your overall tax diversification to have some dollars in non-retirement accounts? If so, really from day one, you want to be mindful of the taxes so that you avoid a tax drag and tax surprise, being more tax efficient with those dollars. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.